Annuities. What is annuity? Annuity, annual, every year. I'm sure, I didn't take Latin, but I know there's probably a base in Latin for the word annuity. But annuity income, it's fixed income, income you receive every year. These are, you could think of them as investment products. And we'll talk about these two situations that we see: a fixed period annuity and life annuity. If you are familiar with what an actuary is, actuaries are incredibly smart people. They are dealing with a lot of statistics, numbers, amounts, and they work for insurance companies to value you as a person, how long they expect you to live. Gotta love it, based on many, many factors. And why do they do that? Well, because you can go to a financial institution and buy an annuity. And for example, a life annuity, you could say, I'm going to give you $150,000, as we see here. I know I'm jumping around again. And I want to get I want a monthly payment, $2,000 for the rest of my life. And well, the company wants to make money, right? So it's kind of like a gamble. Now, for this person, yeah, it'll kind of set them up for life, right? If they do end up living longer than they expected, it'll help this person out, especially as they get older and they have a lot of bills. But the company also, it's kind of, again, it is a gamble. You're gambling, but hey, it's it's kind of like insurance, right? It's like if I end up living longer than expected, I will continue to get these annuity payments. However, we also have fixed period annuities. It's kind of like a security certificate of deposit. It's like financial security, right? Kind of thinking like a fixed income bond situation. Just giving a nice general overview of all of this. Investment products. So for a fixed period annuity, we can go to a financial institution and we could buy this. The expected value is calculated by multiplying the monthly payment by the number of months the annuity payments will be made. The return of capital percentage is calculated by dividing the original investment by the expected value. This percentage is going to represent the tax-free portion of each annuity payment, as it is the return of the original investment. The remaining portion of the payment will be considered taxable income. Now let's see this as an example. And why is it important? Well, as you probably figured out, we need to consider what is considered taxable income, because that's going to be going in your 1040 and you're going to have to pay that out. So you are buying a investment product here. Your original investment was $200,000. So you gave $200,000 to some company, some financial company, and it's a fixed period annuity, meaning it's not for life, but it's for a fixed period of 20 years. It pays you $1,000 per month for 20 years. So the expected value is going to be $1,000 times 20 years times 12 months. That's $240,000. So what is the gain here? Essentially, it's $40,000. Cool. That's fixed, set in stone. Should you do this? Should you not? I don't know. I've never really dealt with annuities, but feel free to look into it yourself if you so choose. Now, how do we determine which of these amounts, what portion of these payments is taxable? That's actually important, because do you just consider all of it first as return of capital, return of your initial investment, or just a portion? And the treatment for this is a portion. Now, the return of capital percentage is 200,000 initial investment divided by 240,000. That gives us 0.83333, and you got to round that, or 83.33%. So each month that John receives $1,000, it's $1,000 times 83% gives you $833. That's considered a tax-free return of capital, because that's the percentage of this is your initial investment. And you're not going to get taxed on the money, because this is money, presumably, that John, let's say, earned from a job, and obviously John got taxed on that money. So why would John pay tax on this again, just because he decided to invest it? The only thing that John's going to get taxed on is the extra gains he makes from this decision. So 83% of each $1,000 is a tax-free return of capital. So the remainder, 1,000 minus 833, or just simply $166.70, will be considered taxable income. And for the year, $166.70 times 12 months, that's going to be your taxable income from this annuity. Oh boy. Not too bad. I mean, it's a lot. For sure, it's a lot, but it is something that we can definitely get a handle on. Not too complicated once you go through it. And if you need to, feel free to take a look again. Watch the particular clips again, practice more questions. You can do it. Now, for life annuity payments, these are different. And like I said, these are kind of a gamble. Whereas for fixed period annuity, you know that, okay, you're getting $40,000 of gain, but it's over the course of 20 years. So for the company, the financial company, maybe this is a good decision for them, because money today is worth more than money tomorrow, so they get to use that $20,000, invest it, grow it. That's the whole business. That's showbiz, right? For life annuity payments, the expected return of basis is calculated by dividing the original investment by the expected life of the taxpayer, and that's determined by actuarial tables, by actuaries, by those probably these days, algorithms and lots of computer programs. God, I'm sounding like I don't know what's going on. The taxable income is the difference between the payment amount and the return of basis. If the taxpayer lives longer than the expected life, may we all do so, hopefully, in a happy and healthy way, all subsequent annuity payments become fully taxable. Let's see how that all works. So we purchased a life annuity that pays $2,000 per month. What did we initially invest? So we gave up $150,000 in cash, and we had the expectation that every month we're going to get $2,000 until we die. The expected life, according to actuarial tables, is 20 years. So the expected return of basis would be 20 times 12, and that is going to give us $625 per month, $150,000 divided by the amount. That's the per month amount. So each month, $2,000 minus $625, which is $1,375, that's considered taxable income. However, if Jane lives longer than 20 years, everything after that, fully taxable. Should you do this? Should you not? I don't know. Totally up to you. Up to your tax decision. I'm not one here to tell you an answer. But I don't know. I guess better to live a longer, hopefully she's living a healthy life and receiving those payments. But the downside is you have to pay tax on it. All right, Social Security income, a little bit similar to those annuities. So, very interesting thing to see here. Let's dive in how this works. So, we pay into Social Security. We talk about that a lot throughout the exam. That's withheld from our paychecks, and that goes into this big fund. It's a Social Security fund. And is it going to be available for us when we retire? Probably not. That's a whole nother issue, is the fact that, yeah, we may not actually receive that money when we are retirement age, but hey, that's life. Social Security income, so this is for retirees. They're receiving their Social Security income that they hopefully paid into for their entire careers. This can be included in an individual taxpayer's gross income, depending on the individual's overall income level. Now, for tax purposes, the IRS uses a concept called combined income in order to determine how much of a taxpayer's Social Security benefits are taxable. Combined income is calculated as the sum of the taxpayer's HEI, non-taxable interest, and one half of Social Security benefits. So that kind of sucks, right? You spend your life working, you contribute into the Social Security system, and just because you end up making a lot of money, you don't get that money back. That's just the way the world goes, I guess. Based on the combined income, the taxability of Social Security benefits is determined as follows. So for lower income, if a individual taxpayer's combined income is less than $25,000 for single filers or $32,000 for married filing jointly, their Social Security benefits are not subject to federal income tax. For middle income range for single taxpayers with combined income between $25,000 and $34,000, or married filing jointly taxpayers with combined income between $32,000 and $44,000, up to $55,000 may be subject to federal income tax. And if you're in the upper income echelon, if a single taxpayer's combined income is over $34,000, or a married filing jointly taxpayer's combined income is over $44,000, up to 85% of their Social Security benefits may be subject to federal income tax. So yeah, you're getting slammed with taxes there. Kind of sucks. This originally was money taken out as taxes, and now when you get it back, it is getting taxed again. That is just how the tax code works.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.